On October 17, 2025, President Donald Trump signed an executive order that immediately grabbed global attention. The order imposed tariffs on imported vehicles, specifically targeting medium and heavy-duty trucks at a rate of 25% and passenger buses at 10%, with the tariffs scheduled to take effect starting November 1, 2025. This action reflects a continuation of Trump's long-standing industrial and economic policy agenda, emphasizing protectionism, domestic manufacturing, and the revitalization of American industrial capabilities. The announcement was framed as a decisive move to bring American manufacturing back, strong and fast, signaling a renewed focus on economic nationalism in a period of global uncertainty and trade tensions. The tariffs on imported trucks and buses are not just a minor policy tweak, but a strategic attempt to recalibrate the U.S. manufacturing and supply chain landscape. Trucks and buses are critical components of both domestic logistics and international trade. Medium and heavy-duty trucks, for instance, form the backbone of goods transportation across North America, while buses are integral to urban transit systems. By imposing tariffs on these vehicles, the administration is clearly seeking to incentivize domestic production and reduce reliance on foreign imports. The political rationale is equally significant. By targeting imports in sectors that are visible to both the public and local economies, the executive order appeals to a base that prioritizes job creation, industrial self-reliance, and national pride. Trump's statement underscores the performative aspect of policy. It conveys a sense of action and decisiveness to both domestic audiences and international trade partners. Analysts have noted that beyond immediate economic implications, the order serves as a signal of intent, demonstrating the administration's willingness to use executive authority to shape trade policy in alignment with the America First agenda. Economically, the tariffs could have multiple downstream effects. In theory, higher import costs could make domestic manufacturing more competitive by increasing the price of foreign vehicles relative to U.S.-made trucks and buses. This may incentivize automakers and suppliers to invest in domestic production, potentially creating jobs and stimulating regional economies. However, these tariffs also raise concerns about cost pass-through to end consumers, particularly in logistics and public transportation sectors, which rely heavily on imported vehicles and parts. The timing of the announcement is notable. Coming in the final quarter of the fiscal year, the order coincides with ongoing debates about infrastructure investment, federal budget allocations, and monetary policy. By linking trade policy with domestic industrial priorities, the administration seeks to consolidate its messaging around economic sovereignty and strategic industrial planning. This reflects a broader pattern in which trade actions are increasingly used as levers to influence both domestic policy and global negotiations. Internationally, the order is likely to generate immediate responses from trade partners. Although Trump's rhetoric emphasizes strengthening U.S. manufacturing, the targeted countries, Mexico, Canada, Japan, Germany, and Finland, are all key allies and major sources of imported trucks. The tariffs therefore risk diplomatic friction and could prompt retaliatory measures or renegotiations of existing trade agreements. Global markets responded cautiously, reflecting both the potential economic impact and the uncertainty about how foreign partners will react. From a financial markets perspective, the announcement initially led to a boost in investor confidence. Market participants interpreted the move as a signal of policy decisiveness and commitment to pro-U.S. industry measures. Yet, the longer-term impact remains contingent on the interplay between trade policy, domestic manufacturing responses, and international reactions. Analysts have warned that while tariffs can temporarily stimulate domestic production, sustained industrial growth will require complementary measures such as infrastructure investment, technology adoption, and workforce development. In summary, the executive order imposing new tariffs on trucks and buses is a multifaceted policy move that combines economic strategy, political signaling, and industrial planning. It reflects the administration's commitment to reshaping U.S. trade and manufacturing priorities, while also introducing uncertainty for domestic and global markets. The policy underscores a broader shift toward protectionist strategies aimed at bolstering domestic industry and asserting national economic sovereignty. The tariffs imposed by the Trump administration disproportionately affect U.S. allies rather than traditional economic adversaries. The top 5 sources of imported trucks and buses, Mexico, Canada, Japan, Germany, and Finland, are all long-standing partners with deep trade and diplomatic ties to the United States. These countries have contributed significantly to North American and global supply chains, providing not only vehicles, but also specialized components, engineering expertise, and manufacturing innovation. By targeting imports from these allies, the executive order introduces a layer of complexity to international economic relationships and raises questions about potential diplomatic repercussions. From an economic standpoint, the tariffs could disrupt roughly $20 billion in annual truck trade alone. This includes both finished vehicles and essential parts that support the logistics and construction sectors. Industries reliant on imported trucks and buses may face higher operating costs, which could be passed along to consumers, contractors, and municipal agencies. Additionally, production timelines for U.S.-based manufacturers could be impacted if domestic supply chains are unable to meet the sudden surge in demand triggered by reduced imports. This dynamic underscores the tension between policy objectives aimed at strengthening domestic manufacturing and the practical realities of industrial supply chains that are deeply integrated with global partners. The U.S. Chamber of Commerce publicly urged the administration to reconsider the tariffs, warning of potential economic disruption and the negative effects on strategic allies. Their concerns highlight the delicate balance policymakers must strike between domestic economic goals and international trade obligations. By targeting allied countries, the United States risks undermining its relationships and potentially prompting reciprocal measures. This could complicate broader trade negotiations, hinder collaboration on supply chain security, and introduce volatility into markets that have come to rely on stable trade flows. Diplomatically, the tariffs also raise questions about signaling and trust. Allies may perceive the move as unilateral and disruptive, which could affect cooperation in other areas such as security, technology, and environmental agreements. The perception of unpredictability in U.S. trade policy can undermine confidence in long-term partnerships and force affected nations to reconsider sourcing strategies, regional investments, or even joint defense arrangements. In this sense, the economic decision has geopolitical ramifications that extend beyond immediate industrial outcomes. Despite these risks, the administration framed the tariffs as a tool to bolster domestic industry and create American jobs. The messaging emphasizes the strategic necessity of prioritizing domestic production over reliance on imports, even from friendly nations. By focusing on job creation and industrial growth, policymakers hope to secure domestic political support for a potentially controversial measure, highlighting the tension between short-term economic disruption and long-term industrial strategy. The tariffs also highlight a broader trend in global trade policy: the use of economic leverage to shape both domestic and international outcomes. While traditionally, trade measures have targeted adversaries or competitors, this action demonstrates a willingness to recalibrate relationships with allies to achieve specific industrial objectives. The decision reflects a complex interplay between economic nationalism, domestic political priorities, and international diplomatic considerations, illustrating the challenges of navigating integrated global markets while pursuing sovereign economic policies. In essence, the tariffs on imports from U.S. allies represent a strategic gamble. On one hand, they are designed to stimulate domestic manufacturing and signal policy decisiveness. On the other hand, they risk diplomatic strain, potential retaliation, and disruption of supply chains critical to both domestic and global economic stability. The administration's approach underscores the delicate balancing act required to align domestic economic ambitions with the realities of international trade, demonstrating that industrial policy cannot be viewed in isolation from geopolitical and market contexts. Following the announcement of new tariffs on imported trucks and buses, U.S. stock markets responded positively, with major indices closing higher on the day. The Dow Jones Industrial Average increased by 238.37 points, or 0.52%, ending at 46,190.61. The Nasdaq rose 117.43 points, also a 0.52% increase, reaching 22,679.97, while the S&P 500 gained 34.94 points, or 0.53%, to close at 6,664.01. At first glance, this may appear as a straightforward policy cheer, yet understanding the underlying dynamics reveals a more nuanced interpretation of market sentiment, investor psychology, and the interplay between trade policy and financial markets. The immediate rally can be attributed to several factors. Investors interpreted the tariffs as a signal of decisiveness and policy confidence from the administration. Markets often respond favorably to signals of governmental control and direction, especially in areas of economic strategy where uncertainty can depress investor confidence. By announcing tariffs, Trump demonstrated a willingness to assert control over industrial policy and to take tangible steps to reinforce domestic manufacturing. For investors, such signals are sometimes interpreted as providing a framework for predictable outcomes, even if the measures themselves introduce economic disruptions. Another factor contributing to market optimism is the perception that tariffs could stimulate domestic production. In theory, by increasing the cost of imported trucks and buses, domestic manufacturers gain a competitive edge. Investors often favor companies positioned to benefit from government policy shifts, particularly if those shifts promise expanded market share or higher revenue streams. In this case, U.S.-based truck manufacturers and component suppliers may experience increased demand, potentially translating into higher earnings and improved valuation metrics. This policy tailwind is a common driver of short-term market rallies, where investor behavior is influenced as much by expectations of future profitability as by current earnings. Analysts have also pointed out that the rally reflects broader sentiment beyond the tariffs themselves. Market participants are increasingly focused on geopolitical strategy, domestic industrial revival, and the messaging surrounding the administration's America First Industrial Revival agenda. By taking visible action, the administration is creating a narrative of pro-U.S. industry, economic sovereignty, and strategic policy. Financial markets, particularly equities, are sensitive to narratives that promise stability, industrial growth, or competitive advantage. In this context, the rally can be understood as a market reaction not solely to economic calculations, but also to the symbolic signaling embedded in the policy announcement. However, it is critical to recognize the limitations of this market response. While indices rose, the gains were modest relative to broader market volatility. Investors may be cautious, interpreting the tariffs as only part of a longer-term, uncertain policy landscape. The rally does not guarantee sustained gains, as subsequent economic data, international reactions, and supply chain adaptations could moderate or reverse initial optimism. Additionally, markets are forward-looking, and traders often price in expected outcomes, including potential retaliation by allied countries, disruptions in logistics and manufacturing, and changes in consumer behavior. Therefore, while the immediate market reaction appears positive, it may be more reflective of short-term sentiment than enduring economic impact. In conjunction with the new tariffs on imported trucks and buses, the White House Office of Management and Budget, OMB, confirmed a freeze of $11 billion in federal infrastructure funding, primarily affecting cities governed by Democratic leadership. This announcement introduces a critical dimension to the administration's broader economic strategy, illustrating the interconnectedness of trade policy, fiscal management, and domestic political priorities. The budget freeze signals a deliberate use of fiscal tools to complement industrial and trade policies, aligning resource allocation with strategic policy goals, while also exerting political pressure. The decision to freeze infrastructure funding carries both economic and political consequences. Economically, infrastructure investment is a major driver of regional growth, employment, and productivity. Cutting or delaying funding can have immediate repercussions for construction firms, labor markets, and municipal operations, potentially slowing down projects that rely on federal support. Regions most affected are those governed by democratic administrations, which introduces a political layer to the economic impact. Analysts have noted that this strategy could amplify the domestic industrial effects of the tariffs by simultaneously incentivizing industrial compliance and reinforcing the administration's broader fiscal priorities. Economic advisor Kevin Hassett highlighted the potential for more aggressive policy measures if a government shutdown continues, suggesting that the administration may further leverage fiscal tools to achieve policy objectives. This interplay between trade policy and fiscal management underscores a broader strategic vision in which executive authority is used to align multiple levers, tariffs, budget control, and regulatory guidance, toward a coherent economic objective. By combining these tools, the administration seeks to maximize the impact of industrial revival measures while signaling seriousness and resolve to both domestic stakeholders and international partners. The freeze also introduces a risk factor for broader economic stability. Federal infrastructure funding supports jobs, investment, and local economic activity. Delaying or withholding these funds may slow economic growth in affected regions, potentially counteracting the stimulative effects of tariffs on domestic manufacturing. Additionally, municipalities may face challenges in maintaining projects, fulfilling contracts, and managing public expectations, which could introduce political friction and erode trust between federal and local authorities. From a market perspective, investors may interpret the budget freeze as both a risk and an opportunity. The move could dampen regional economic activity, impacting sectors such as construction, materials, and transportation. However, markets may also view the combined strategy, tariffs plus fiscal control, as an indication of the administration's commitment to reshaping the industrial landscape. The dual policy approach reinforces the narrative of a coordinated industrial revival, which can influence investor sentiment and market expectations, even in the face of short-term economic disruption. Politically, the budget freeze serves as a signaling mechanism, demonstrating the administration's willingness to assert authority and enforce compliance with broader policy goals. By targeting funding toward opposition-led regions, the administration conveys both a message of strategic prioritization and a subtle form of political pressure. This approach reflects a broader trend in which fiscal tools are used not only to manage resources, but also to shape political behavior, influence policy compliance, and advance strategic objectives. In essence, the budget freeze, when considered alongside the new tariffs, represents a multifaceted policy approach. It combines trade protectionism, fiscal authority, and political signaling to advance domestic industrial goals while navigating complex economic, market, and diplomatic landscapes. The decision illustrates the interconnectedness of modern policy tools, where tariffs alone are insufficient to achieve strategic outcomes, and fiscal measures are employed to reinforce industrial priorities and maintain leverage over domestic and international stakeholders. In the aftermath of the tariffs and budget freeze, attention turns to monetary policy and the Federal Reserve's role in shaping the economic environment. White House economists and advisors anticipate additional rate cuts by the Federal Reserve, with Kevin Hassett suggesting that the 3 cuts already planned are merely the beginning of a broader monetary easing cycle. This expectation reflects the administration's strategic coordination between fiscal, trade, and monetary tools to support industrial revival and economic stability. Monetary policy is particularly relevant in the context of trade-driven economic adjustments. Tariffs, by raising the cost of imported goods, can create inflationary pressures, particularly in sectors reliant on imported components. By signaling potential rate cuts, the administration seeks to offset some of these inflationary effects, ensuring liquidity and maintaining consumer and business confidence. Lower interest rates reduce the cost of borrowing, facilitate capital investment, and support credit availability, which is especially critical for manufacturing and infrastructure projects impacted by tariffs and budget adjustments. The administration's vision, described as an America First industrial revival, reflects a multi-pronged strategy. Tariffs, fiscal control, and monetary easing are deployed simultaneously to achieve three primary objectives: stimulate domestic industrial growth, maintain macroeconomic stability, and assert policy leadership on both domestic and international fronts. By coordinating these tools, the administration aims to create a favorable environment for domestic producers while signaling long-term commitment to industrial and economic sovereignty. Financial markets are closely monitoring the Fed's response. Investors understand that monetary policy will influence liquidity, borrowing costs, and overall economic momentum. While rate cuts can provide short-term support for equity markets, they also raise concerns about long-term inflation, fiscal sustainability, and potential asset bubbles. The interplay between trade policy, budget adjustments, and Fed interventions creates a complex environment where markets must weigh immediate gains against longer-term risks, adjusting investment strategies and portfolio allocations accordingly. Looking ahead, the administration is likely to continue using executive authority to shape industrial policy while coordinating with the Fed to maintain favorable economic conditions. Infrastructure funding, trade tariffs, and monetary policy are being treated as interconnected levers, allowing the government to respond dynamically to economic challenges, supply chain disruptions, and international trade pressures. This coordinated approach reflects a strategic understanding that domestic industrial revival requires alignment across multiple policy domains rather than relying on a single intervention. Finally, the broader significance of these measures lies in the signaling effect to international trade partners and domestic stakeholders. By combining tariffs, budget control, and potential monetary easing,